on Sky News Business. This is Switzer.
Hello, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, Switzer Super Reports Paul Rickard and Medallion Financial Group's Michael Wayne joined the program for the latest market analysis. For more on what drove the local market this session, I'm joined by Switzer Super Reports Paul Rickard and Medallion Financial Group's Michael Wayne. Guys, thanks for joining us.
Thanks, Peter.
Let's kick off on the banks, Paul, and this is your beat. ANZ and Westpac went ex-dividend today. Well, the fact that we didn't drop by much, was that a pretty good sign?
Yeah, I'd say the market gets an 8 out of 10 for today's performance.
Mike?
Yeah, look, it's a continuation of the good run that we've seen. We've managed to breach the 6,000 level and now we're consolidating, which I think is a little bit healthy. I don't think we want to see us sort of shoot away too quickly. The fact is, although earnings revisions are coming out to the positive, to the upside, the vast majority of the rally that we've seen has been a pure shift in sentiment. So I think the ASX has lagged a lot of the international markets, as everyone knows, this year. Probably got out of hand a bit too much and we're playing a bit of catch up now. So I do expect that we can push on a little bit further, but nothing too much, nothing too crazy really.
Why the sentiment shift?
Look, it's difficult to say. I think we got through reporting season unscathed. The US reporting season's been quite good as well. We've had this global synchronised growth that everyone's been talking about, and there aren't too many clouds on the horizon. Commodity prices have been fairly strong as well. So it's been a fairly positive sentiment globally, so I think that's really flowed through to our market. Yeah, we also had the seasonal factors. October is traditionally a very strong month for the market, a lot of dividends.
So you guys react to that kind of thing? It's seasonal, better buy stocks?
Oh, no, I think it's more that what happens, a lot of companies pay out their dividends, although they might have gone ex-dividend the month before. That cash physically hitting people's accounts comes through in October, and a lot of the institutions, a lot of the private investors will put some of that money to work. That's one of the reasons, not the entire reason, but it's certainly something I think that's played out consistently over the last 10 years or so.
Paul, before we broke 6,000, people said, well, if the banks don't participate in this rally, because the commodity price rally was helping the stock market, we never break 6,000. Why have the banks been marked up again? Can they grow revenue?
Look, it's going to be a lot more difficult in this environment. The housing market softening, APRA's cracking down on the amount of investor lending, for instance, and household lending in some respects as well. So without the big explosion in credit, it's very difficult for housing prices to keep rallying. It's very difficult for banks to continue to grow their net interest margins at the rates that we've seen in the past. So it's going to be a lot more challenging environment for them to grow their revenue. It's one thing to cut costs, but at the same time, some of the banks at the moment are being forced to invest in technology upgrades. CBA perhaps is a little bit ahead of the game when it comes to those sorts of things, so they're going to get squeezed on a couple of different measures at the moment. So when it comes to the banks, I'm pretty neutral at the moment. I think they're more of an income and dividend play, and you can expect maybe a little bit of capital gain as the cherry on the top.
6,000, is it going to be a support level? And if we can rule out something really scary from overseas, do you think this market's going to keep crawling up from 6,000? Look,
that's my feeling. I don't think it's going to happen overnight. I think the big gains that we had through October and the early stages of November are going to be the majority of it for now. I think what's been encouraging, it's been quite a broad-based rally in that it's been the smaller mid-cap stocks that have been helping drive the market high. We haven't necessarily been relying completely on the big four banks, which has been the issue in the past. I would like to see it consolidate. Some of the valuations are becoming stretched. For example, the price of your small caps or your mid caps relative to your large caps is very, very stretched by historical measures. So you want to see things sort of settle down. You want to see at least the earnings revised higher. We want to get through the AGM season, which we're currently in the midst of, just to make sure everything's okay as we lead into the end of the year. But I do think that can be a support level going forward, barring anything unforeseen.
What about Domain listing on Thursday? What's your take, Mike?
Look, it's a space that's been doing very, very well. Look at the performance of realestate.com and perhaps you can draw a bit of a bow between the two. If you look at sort of these divestments over the last few years, more often than not they've performed quite well. You look at sort of S32, you look at things like Aurora or Clydesdale Bank. So perhaps Domain will be another one of those. Their most recent update was fairly strong, although the update from realestate.com was equally as strong, and it almost showed that they're taking market share in some of the space that Domain's meant to be quite dominant in. So my preference is still for REA, but I would like to see how it comes on Domain as how it starts trading, because it could be one worth looking at. Potentially even sort of if you do have some realestate.com, selling a portion of that and putting it into Domain. But it's an interesting IPO.
I'm not going to let you guys get away without giving us your best investment idea right now. Mike?
At the moment, looking at Janus Henderson Group, I've sort of mentioned in the past things like Altium and Platinum, they've run pretty hard. So when I'm looking for a bit of value in this market, it's not that easy. So Janus Henderson, they're a diversified fund manager. They've recently done a merger between Henderson and Janus in the US, and that gives them a nice distribution channel into the United States. They had the first quarter of inflows since the Brexit. With their most recent update, they've had about 80% of their funds outperforming over 1, 3 and 5 years. And it trades on about 14, 15 times earnings when the likes of Magellan, when the likes of BT trade, and Platinum even trade on around sort of 20 to 22 times earnings. So I think there's some relative value in something like Henderson.
Yeah, but Janus is kind of famous for bonds. Henderson is not just bonds.
That's right.
Are they more diversified now because of the merger?
Yeah, they're far more diversified. They have about, I think, 50% in equities and about 30% in fixed income. And Janus is very famous for fixed income, as you say, through Bill Gross, the famous bond king, the guy that started PIMCO. So that sort of network is a good diversification tool for them in geographical sense, because in the past Henderson had a very strong orientation towards Europe and towards the UK. That was seen as a big negative with the Brexit, the uncertainty that was creating and the falling pound. They've managed to diversify themselves away from that now, and I think that over time the money will start to flow back their way.
Paul, thanks very much. Mike, great to see you.
Peter.
Okay, coming up after the break, we have car sales CEO Cameron McIntyre joins me on the program. Let's just see what the crazy new world of cars could do to a very good business like this.